here. So explaining how the equilibrium interest rate is determined, list and explain the main functions of the Bank of Canada, explain the goals and tools of monetary policy, describe the overnight lending rate and how the Bank of Canada directly influenced it, explain how monetary policy affects real GDP and the price level, explain the advantages and shortcomings of monetary policy, describe the effects of operating monetary policy in an open economy, describe how the various components of macroeconomic theory and stabilization policy fit. So interest rates show the demand for money. So transactions demand DT is demand for money as a medium of exchange. It varies directly with GDP. Asset demand is DA, so it's demand for money as a store of value, varies inversely with the interest rate. Total demand is DM. It's the horizontal summation of the asset demand and transaction demand. So this is the graph for total demand for money and supply. So the supply curve is the vertical one. So this is supply, this is the demand. So the interest rate is on the y-axis, so the interest rate here. And then amount of money demanded and supplied is on the x-axis. So here, 5% interest rate, $200 billion equilibrium quantity money supply. So here that's what it would be showing there, that it would be about 200 billion in supply and equilibrium here. So yeah, in equilibrium, you'd have a 5% interest rate with a $200 billion money supply. Yeah. So this is pretty similar to right now, except in Canada, it's about a 5% interest rate roughly. And the money supply is 10 times that. So it would be like 5% interest rate at $2 trillion money supply. So we combine the demand for money with the supply for money to determine the equilibrium rate of interest. Interest rate is the price paid for the use of money. Equilibrium interest rate is the demand for money combined with the supply of money to determine the equilibrium rate of interest. So here, so interest rates and bond prices. So when the interest rate increases, bond prices fall and vice versa. So if there's $1,000 bond here and it pays $50 of annual interest, what is the interest rate on the bond?
%5.
Yes, thank you, Zaitong. Yeah, yes, 5%. So you do 50. So you do the annual interest divided by bond price. So that'd be 50 divided by 1,000. That'd be 0.05, which is 5%. Great job. Great job, Minji, also. So that's how you do that one. Yeah, so $50 divided by $1,000 equals 5%. And then when the interest rate rises to 7.5%, what will the bond price fall to? So I'll show you here, and then we'll do some more examples here. So to do this, you would have to do, you take the $50, so you take the annual interest, divided by the interest rate. Find the bond price. So in this case, it'd be 50 divided by 0.075, and you get 667. So that's how you'd get that there. You'd have to take the annual interest divided by the interest rate. Yeah, so that's what you do. You take the annual interest amount divided by the interest rate. That equals bond price of $50 divided by 0.075 equals 667. And then based on that, I'll keep this up. If the interest rate falls to 2.5%, what will the bond price rise to? $2,000. So yeah, great job. Great job, Minji. So it was it was 2,000. So it'd be 50 divided by 2.5%, which is $2,000. Great job. So again, it would be annual interest amount divided by the interest rate equals bond price. It's 50 divided by 0.025 equals 2,000. Great job. So put this in the chat here. So the functions of the Bank of Canada, the country's central bank, can be divided into 5 categories. So 1, acting as the banker's bank. The charter banks turn to the Bank of Canada as their bank, the lender of last resort. 2, issuing currency. So the Bank of Canada supplies the economy with paper currency, Bank of Canada notes and coins. So if a bank cannot borrow from another bank because the other bank doesn't have enough money right now, the bank can borrow from the Bank of Canada. So so the Bank of Canada prints money so other banks can borrow from them. So that's what happens here. Put this in chat here. And they also act as a fiscal agent. They provide financial services such as banking to the federal government. So they lend to the federal government if they need money. Supervising the charter banks, they make periodic assessments of the bank's profitability to verify that the charter banks perform in accordance with the regulations, and they regulate the supply of money. So a key task of the bank is to manage the money supply and thus the interest rate according to the needs of the economy. Bank of Canada independence. So Parliament established the bank as an independent agency of the government, protects from political pressures in order to effectively control the money supply and maintain price stability. Voters hold Parliament accountable. Countries with independent central banks have lower rates of inflation on average than countries with little or no central bank independence. So I'll ask the class, why do you think this is here?
Is it to do with coordination or lack of coordination?
Yes, so yeah, that's true. It's good to coordinate across different countries. That's true. Yeah, good job, Brooke. Also, so like yeah, lack of coordination. Uh, also the if the central bank is part of the government, there can be potential corruption. So like political leaders could print money and pocket it. So that happens. That happens in nations with central banks that aren't independent. So that does happen. Yeah, and that's important. Also, if the central bank is not independent and part of the government could print more money or print less based on political pressure. So that would be a problem here. So that's so we want to prevent that as much as possible. So I'll put this in the chat. So central banks select nations. So the monetary policies of the central banks in these world's nations are often in international news. Here are some of the official names along with a few of their popular nicknames. So Australia is Reserve Bank of Australia, RBA. Canada is Bank of Canada. Eurozone is European Central Bank. Japan is the Bank of Japan. Mexico is the Banco de Mexico. Russia is the Central Bank of Russia. Sweden is Sveriges Riksbank. United Kingdom is Bank of England. United States is Federal Reserve System of the Fed. So the consolidated balance sheet of the Bank of Canada is assets, which will be securities and advances to charter banks. So for the most part, their assets are mostly loans to other banks and people and businesses. So that's mostly what it is. And then liabilities, their liabilities are mostly deposits and borrowing from banks and the Bank of Canada. So that's how their balance sheet is made up mostly. So I'll post this in the chat here. So as you can see here, this is like a example of the Bank of Canada's balance sheet. So they have their assets are advances to charter banks, treasury bills of Canada, government of Canada bonds, securities purchased under resale agreement, and other assets. And then the liabilities are what they borrow. So notes of circulation, government of Canada deposits, charter bank deposits, other liabilities. So liabilities are borrowing, and then assets are mostly lending for banks. So bank assets are mostly lending, and then bank liabilities are mostly borrowing. So that's how the balance sheet is made for the most part. Let's chat too. So the objective of the Bank of Canada's monetary policy. So their objective is to keep inflation low, stable, and predictable, to moderate the business cycle, and to help the economy achieve full employment and sustained growth. They are supposed to alter the money supply to influence interest rates. Their inflation target range is 1 to 3% annually. So their main job, the Bank of Canada's main job, is to keep inflation at 2% target. So that's their main job. Everything else is extra. Yeah, so that's basically what they do. Their main job is keeping inflation at 2%. So the thing is, the benefit of keeping, so the benefit of keeping, the benefits of keeping inflation at 2% is that it achieves other goals like keeping the economy stable, supporting full employment, and sustained growth. So like it meets all these other goals. So if you keep inflation at 2%, you can achieve this, this, and this. So that's the benefit of that. It leads to all three of those things. So it's a great thing that they do to keep inflation at 2%, because it makes sure that we moderate the business cycle, we help the economy achieve full employment and sustain growth. So that's their key. As long as they keep inflation near 2%, the economy is going to be okay. That's really it leads to a lot of other good things if they keep inflation at 2%. Yeah. So that's why their main goal is inflation keep 2%, because it leads to all these other good things like moderating the business cycle, helping the economy achieve full employment and sustain growth. That's why they're so important, because that's the best rate of inflation to keep things to keep the economy good, basically. So put that in the chat for everyone. So here, tools of monetary policy. So bond markets are open to all buyers and sellers of corporate and government bonds, securities. So involves buying and selling government bonds from and to chartered banks and the general public. The overnight lending rate. Occasionally, chartered banks have unexpected and immediate needs for additional funds. In such cases, the Bank of Canada will make short-term loans to chartered banks. Bank rate is the interest rate charged by the bank when it lends to chartered banks. So how this works is the government buys bonds from banks to increase the money supply. So that's how they increase the money supply, by buying bonds from banks. And the government sells bonds to banks to decrease the money supply. And then banks borrow from other banks to pay for withdrawals, and they pay the bank rate for interest in the borrowing. And like I said before, if other banks don't have any money to lend, the bank will borrow printed money from the Bank of Canada. So that's how the banking system works, and it's a very effective system. It's really based on borrowing and lending. Yeah. So the banking system is really based on borrowing and lending completely. So the banking system is run on borrowing and lending. So the bank rate and the overnight lending rate. So the bank rate is the interest rate the Bank of Canada charges on the loans to the charter banks. Bank rate is set at the upper end of the Bank of Canada's operating band for the overnight lending rate. Bank has a publicized target for the overnight lending rate. So open market operations. When the Bank of Canada buys government bonds from the charter banks give up part of their holdings of securities, the government bonds to the Bank of Canada. Bank of Canada, in paying for these securities, places newly created reserves in the accounts of the charter banks of the Bank of Canada. These reserves are created out of thin air, so as to speak. The reserves of the charter banks go up by the amount of purchased securities. So yeah, when they buy government bonds from charter banks, when they buy these bonds from charter banks, this increases the money supply. Yes. Yes, so if bank reserves, if so bank reserves mean cash. So if if let's say if TD Bank has an increase in the bank reserves that they hold inside of TD Bank due to the Bank of Canada buying TD bonds, this would increase the money supply. And if TD Bank lends out those reserves as loans, this will further increase the money supply. So lending increases the money supply. Yeah, no problem. So it's all based on lending. So lending increases the money supply. So I'll show you the visual for how this works. So when the Bank of Canada buys bonds from charter banks, the amount of securities will go up at the Bank of Canada. So they're lending here. So they're lending. And then they're and then deposits of charter banks reserves go up. So that's how the visual goes. And charter banks, their securities go down because they're transferred from so they go here and then the reserves go up. So so buys securities here, sells securities, and then earns reserves from selling securities. Yeah. And then sometimes they put the reserves into the Bank of Canada for safekeeping. Sometimes they send the reserves here. Sometimes. And if they don't do this, they might lend it out to people. So if they don't do this, they may just lend it out. But in this case, they're just storing it at the Bank of Canada. And securities mean bonds. Securities mean bonds. Yeah. And I'll say here that sometimes they store. Sometimes they store their reserves at the Bank of Canada. So open market operations. So the Bank of Canada sells bonds to the public. Public buys bonds with a check. Check is cleared in the charter bank. Charter bank's reserves decrease. So the Bank of Canada's bond sales of $1,000 charter banking system reduce the system's actual and excess reserves by $1,000. But a $1,000 bond sale to the public reduces excess reserves by $800. So in this case, if the Bank of Canada sells bonds to the public, the money supply goes down. So that's what happens here. So what happens is when they sell bonds, the Bank of Canada sells bonds, securities, here. And then the banks need to spend their reserves on these bonds, securities. And then the banks buy bonds from the Bank of Canada, increasing bonds/securities in their account here. And then here the bank's reserves go down due to buying bonds. So yeah, here's the balance sheet here. So that's how it works here. Yeah. So open market operations, Bank of Canada buys bonds, charter banks reserves increase, banks increase lending, money supply increases. Bank of Canada sells bonds, charter banks reserves decrease, banks decrease lending, money supply decreases. So this is all you need to know right here. This is what you need to know. So this screenshot is all you need to know. This shows everything that is important about this process. So buying bonds, so Bank of Canada buying bonds will increase the money supply. Bank of Canada selling bonds will decrease the money supply. So that's the basics of what you need to know. Interest rate. Overnight lending rate is the interest rate charged by banks and overnight loans. The Bank of Canada conducts open market operations to achieve the target. So the bank determines the desired overnight rate. So in this case, as you can see, if they reduce the interest rate like this, the money supply increases. So yeah, reduced interest rate here, higher money supply. Yeah. So like that's how it would be shown here. That lower interest rate, higher money supply in this case. Expansionary monetary policy, the bank increases the supply of reserves from SF1 to SF2 to move the overnight rate from 4 to 3.5%. So the overnight rate goes down with a higher money supply. And the Bank of Canada determines desired overnight rate. Expansionary monetary policy, the bank increases the supply of reserves from SF1 to SF2 to move the overnight rate from 4 to 3.5%. Restrictive monetary policy, it decreases the supply of reserves from SF1 to SF3 to move the overnight rate from 4 to 4.5%. So in this case, an increase in interest rate, lower money supply here. Yeah. So as you can see there, higher interest rate, lower money supply. So as you can see, higher overnight rate, lower quantity of reserves, money supply, lower overnight rate, higher quantity of reserves, money supply. So you use expansionary monetary policy when there's a recession. Lower target for the overnight lending rate. Bank of Canada buys securities, expanded money supply, and downward pressure on other interest rates. So expansionary monetary policy is reducing the interest rate / increasing the money supply. And then restrictive monetary policy is used under periods of rising inflation, increases target for the overnight lending rate, Bank of Canada sells securities, increases money supply, and increases other interest rates. So restrictive monetary policy is when reduce money supply / higher interest rates. Yeah. So the prime interest rate rises and falls with changes in the bank rate, the overnight target rate, and the overnight lending rate. So they all of these, so prime rate, prime interest rate, overnight lending rate, bank rate, and overnight target rate move in the same direction. Yeah. So that's what happens. They all move in the same direction. So the prime interest rate is always higher than the bank rate, overnight lending rate, and overnight target rate. Because you are lending to people and businesses with the prime rate, while the other three rates are lending between banks with lower risk. So lower interest rate due to lower risk. So that's how it works. And then, yeah. So the Taylor rule. So if real GDP rises by 1% above potential GDP, the bank should raise its overnight rate by 0.5 percentage points. If the inflation rises by 1% above its target of 2%, the bank should raise the overnight lending rate by 0.5%. When real GDP is equal to potential GDP and inflation is equal to its target, the overnight rate should remain about 4%, implying a real interest rate of 2%. So the Taylor rule is not really used very often. It's more, don't worry too much about it. It's not really used. So let's get back there. It's not something that I would focus on too much. It's not used very often. So the cause and effect chain, the transmission mechanism. So we now want to emphasize how monetary policy affects the economy's levels of investment, aggregate demand, real GDP, and prices. So the transmission mechanism. Money supply impacts interest rates. Interest rates affect investment. Investment is the component of aggregate demand. So I'll ask the class, what happens to investment when the interest rate goes up? Yeah, it goes down. So investment will go down when the interest rate goes up. Yeah, good job. Good job, Simran. So yeah, investment goes down when interest rates go up. Yeah. So I'll put this in the chat here. So you have it in the chat now. So let's pause this for a second. Curve here. With this curve here, this one here, I'll show you what happens here. If the aggregate demand curve, the AD curve, shifts right, the money supply increase. So real GDP goes up and price level goes up. So that's what they do to, this is what happens when this is what happens when they reduce interest rates. So that's just what happens if they reduce interest rates here. Yeah, so as it goes up and up, AD, if the aggregate demand curve, AD curve goes up to the right, the price level goes up and the real GDP goes up here. So here, this is like problem unemployment recession. Bank of Canada buys bonds and lowers the bank rate. Excess cash reserves increase. Overnight rate falls. Money supply rises. Interest rate falls. Investment spending increases and aggregate demand increases. So that's how they solve an unemployment recession situation here. And then real GDP rises. So that's how they solve a recession here. And then inflation. So with inflation, Bank of Canada sells bonds and raises the bank rate. Excess cash reserves decrease. Overnight rate rises. Money supply falls. Interest rate rises. Investment spending decreases. Aggregate demand decreases. And inflation declines. So those are the two things that they do if they want to get out of these things. So this slide is one of the most important slides out there. This gives you the map of what they do to get our economy going again, or getting us out of inflation. So this is one of the most important slides. It summarizes almost everything we learn from this slideshow. So dominant component of Canadian stabilization policy is monetary policy. So the two key advantages of monetary policy over fiscal policy is speed and flexibility and isolation from political pressure. So those are two important points on why we use it over fiscal policy. So why monetary policy is used. And then recent monetary policy in Canada. The Bank of Canada has been highly active in its use of monetary policy in the turbulent times of the least recent past. At the beginning of 2008, as a housing bubble was unwinding and had created a financial crisis that spread across the globe. The overnight rate dropped to 1.5% by the end of 2008, started dropping again in 2008 to an all-time low of 0.25% in 2009, began to increase the overnight lending rates in the autumn of 2010, but rates stayed at historic lows throughout 2014. In January 2020, the rate was 1.75%, and the Canadian economy was close to full employment. 2 months later, the COVID-19 pandemic rate once again lowered to the historic low of 0.25%. So problems and complications. So monetary policy has certain limitations and faces real world complications. So lags, it takes a while for it to take effect. So you may change monetary policy now and it takes a while to take effect. Cyclical asymmetry and liquidity trap. Also inflation targeting. So increased transparency of monetary policy and accountability. So here, net exports effects reinforce monetary policy. So expansionary monetary policy, problem, recession, slow growth. Expansionary monetary policy is lower interest rate, decreased foreign demand for dollars, dollar depreciates, net exports increase. So that's what happens when you have a lower interest rate, then net exports increase. So a lower interest rate will reduce the value of our currency, and net exports will increase because they are cheaper due to our lower value of our currency. Now we have more economic growth due to higher net exports. And then restrictive monetary policy, problem inflation. Restrictive monetary policy, higher interest rate, increased foreign demand for dollars, dollar appreciates, net exports decrease. So here, a higher interest rate will increase the value of our currency, and net exports will increase. So higher interest rate, higher value of our currency, higher, lower net exports. Economy shrinks. So this is a good graph here showing everything that goes on. And the macroeconomic stability and the trade balance. So the easy monetary policy that is appropriate for the alleviation of unemployment and sluggish growth is compatible with the goal of correcting a balance of trade deficit. The tight monetary policy to use to alleviate inflation conflicts with the goal of correcting a balanced trade deficit. So if you raise interest rates, this will reduce net exports and shrink our economy. If we reduce interest rates, this will increase net exports and grow the economy. So there are pros and cons to each policy. So we need to figure out which is better based on the pros and cons at the current time. So less than zero. So fearing the zero lower bound, central banks set low positive interest rates after both the financial crisis and the COVID-19 pandemic. But what if negative rates are actually an option? U.S. financial crisis reached a peak in 2008, stimulated the economy. The Bank of Canada and the Fed lowered short-term interest rates to nearly zero. Strategy known as zero interest rate policy, ZIRP. 2017, both the bank and the Fed were raising short-term interest rates in hopes of getting it back up to historically normal levels. Policy cushion. So they reduce interest rates to grow the economy back, and they raise interest rates to improve affordability. So like if inflation and prices are going up a lot, they have to raise interest rates and reduce the money supply to reduce inflation and make prices affordable. Yeah. So what if another recession started before rates return to normal levels? Quantitative easing, lower long-term rates, set negative rates in an attempt to force banks to lend more. But how negative could rates go before the loss of purchasing power exceeds the convenience that comes from being able to utilize electronic payments? The Bank of Canada must consider these trade-offs, which Canada enters